All right. This is Andrew Stotz of the Valuation Master Class, and we've got another case study. And this one is titled, Is This Car Maker's Parallel Strategy a Potent Value Play? Let me share what I'm talking about. So that's the question that I'm going to ask. And if you have any questions along the way, let me know. Now, this is Andrew Stotz of A. Stotz Investment Research. Welcome to the Valuation Masterclass case study, where we dig into interesting stocks and their valuations. Today's company is Hyundai Motor Company, HMC. Let's get into it. Remember, before we get into it, this video is for learning purposes only. This is not investment advice or a recommendation. So Hyundai sees the future in hydrogen, unlike other car makers. So 3 things you need to know about this company. First, it's a contrarian bet on hydrogen, and it could be a winning strategy. Could be. We'll dig into that in more detail. Also, long-awaited margin rebound could justify a re-rating. Again, could justify a re-rating. So, and the third point, reducing reliance on global supply chains. Well, that's important these days. So consensus, there's 33 analysts covering the company, and consensus forecast has a 38.9% upside, a buy. The price to book value is 0.8, less than book value, and dividend yield is 2.1%. Our estimate is 280,000 Korean won, or 28.4% upside. So let's look at the technicals. What's happening with the price chart? First, we can see the price signal is kind of unclear, but volume supports a bullish signal. Recently, the 50-day moving average closed the gap to the 200-day moving average line. It appears that that 50-day moving average could soon cross the 200-day moving average again, which we would consider a good signal, some strength. The volume relative strength index currently has stayed above the 50% line, which indicates some bullish trend, though we can see it's not that strong over or under. So I would say the technicals are kind of neutral. The share has been relatively flat. So the real question is this stock going to break out? That's the question. So let's look at that in a little bit more detail. First, let's understand the company. Let's look at its revenue breakdown or its sales breakdown. So here we can see vehicles account for about 78% of the total revenue. The top number 1 Korean car is the Hyundai Grandeur, followed by the top second Korean car, which is Hyundai Porter truck, which is actually a truck. And the most famous model in the US is the Hyundai Tucson. And 16% of its revenue is coming from Hyundai Finance. And then there's another 6% from some other items. If we look at the regional breakdown, well, 44%, not surprisingly, is coming from Korea, and US is 29% of their revenue, Europe 12%, and Asia Pacific is only 6%. In fact, you can see, unlike, let's say, Toyota that sells a ton of cars in Asia, basically these guys are mainly focused on their home country, Korea and North America. So what's the story with this company? Well, this contrarian bet on hydrogen could be a winning strategy. I want you to decide, see what you think. Hyundai and Toyota are the only large car producers that are sticking with fuel cell electric vehicles, also called FCEV. They have a 90% market share in this area. Hyundai has allocated 2022 capex of about 1.1 billion US dollars. That's roughly 15% of its total capex budget to develop 2 further fuel cell plants, something similar to what you see in the picture, the bottom right. This brings annual production to 100,000 cars. It's a bold move considering that almost all car makers have exited from the hydrogen to focus on electric vehicles. So what do you think? Can it make something out of this? Well, first, let me explain a little bit about the differences among the electric vehicles. First, we have BEV, battery electric vehicles. This is pure electric vehicles that use rechargeable batteries. Tesla's main approach is this, and it's followed by most other car makers. Then we have PHEV, that's the plug-in hybrid vehicles. hybrid models that use both an electric motor and gas engine. Toyota has been a leader in hybrids for decades. Then there's the fuel cell electric vehicles, FCEV. Instead of a battery, it uses fuel cells that generate electricity, usually through hydrogen. So still, Hyundai is also well prepared for the EV rollout. So here's a chart that looks at the units sold from 2017 to 2021. And what we can see is the battery electric vehicles, well, they're selling about 100,000 of them as of 2021. The plug-in hybrid vehicles are about 40,000, and then the fuel cell electrical vehicles are still very small. Remember, how many hydrogen stations do you see near you? Not many, that's for sure. So the result is it's not easy to get implemented. Now, hydrogen to me, you and me sounds pretty clean, but truthfully, there's also cost to generating hydrogen, which is a byproduct of natural gas. Now, they're a top 5 largest electric vehicle producer. And in 2021, as I showed, they've sold more than 100,000 battery electric vehicles. This gives it a market share of about 5% compared to Tesla's about 15%. The company continues to give equal priority to electric vehicles and hydrogen. If hydrogen turns out to be a more feasible solution, then Hyundai could be a big winner, and all the other car companies would be struggling to get their hydrogen up and running. Of course, if it goes wrong, well, it's a lot of money that they've spent developing this strategy. So that's why they say there's a parallel strategy. Let's look at point number 2. Long-awaited margin rebound could justify re-rating. So Hyundai has fallen from one of the most profitable car makers to below average profitability as of 2020, mainly caused by fierce price competition, higher labor costs, and the recent chip shortage. However, the company's efforts to focus on higher margin car models and reducing SG&A is starting to pay off. If it can maintain this 6 to 7% EBIT margin, it could change the market's assessment of the company. Now, right now, we've already seen it's at 0.8 price to book, so it's relatively cheap. But if things turn around, it could get better. Remember, EBIT margin, as we show in this chart, was as high as 10% in the past. I don't think it would make sense to assume 10% in the future, but now they're at about 6%. If they can maintain that, that's pretty good news. Now, let's look at the third story, reducing reliance on global supply chains. The company missed its 2021 sales target by 4% amid the chip crisis. Still, it was among only 3 car makers that were able to increase sales volume year on year. That's a pretty good feat in 2021. Though its affiliate Hyundai Mobis, the Korean car maker plans to produce its own chips in the future to reduce its reliance on third-party suppliers. And that's something that I would say the Korean car makers, and particularly the business groups in Korea, have the ability to produce these chips, whereas you could argue that maybe General Motors or something like that in the US may not have the capacity to do that on their own. Now, the further integration along the supply chain could lead to long-term cost reductions. So to download today's slide deck, just go to the blog session at valuationmasterclass.com or just scan the QR code that you see there. So let's talk about the FVMR Scorecard. It measures a stock's attractiveness relative to all other companies. Attractiveness is based on the 4 elements that we look at: fundamentals, valuation, momentum, and risk. And it's from a scale of 1, yay, best, to 10, worst. So here we can see the FVMR Scorecard for Hyundai, and let's focus in on valuation. What we can see here is the price to book is at about 0.7 times price to book. So a very low price to book, below the book value. So that is a feature that's pretty strong. Now, the problem that you have is that there's some questions about that I'll answer. But before I do, let's just also review, what does it price to book of less than 1 indicate? Well, book value is the value attributable to shareholders in case the company sells all its assets and repays all its liabilities, which is also called liquidation value. It's important to remember that everything on the balance sheet tends to be at historical cost. So sometimes things could be worth a lot more. A great example is a company that I looked at many, many years ago was kind of a sleepy company and it didn't do much. And then one year the share price went up massively because they had a hidden asset on their balance sheet. They had a huge piece of land outside of Bangkok, Thailand, and they were selling that piece of land and they captured a huge amount of money on the financial statements. In the balance sheet, that money showed up as an asset at historical cost, the cost that they bought that land for about 50 years ago, but then they realized the gain. So a price to book ratio of less than 1 times indicates that the market values the net assets less than the balance sheet suggests. It also means that you can buy this company for a little bit less than what the assets say they're worth, and all future growth of the business you're going to get for free. That's pretty interesting. And just to take a little break, I see a nice comment from Yahaya, and it says, impressive. Yes, we've done a lot of work on this. In fact, we're on the beginning of valuing 60 companies in 60 days, which is pretty exciting. We're enjoying it. Now, let's continue on. If a company trades at very low price to book, it could be either a cheap opportunity to buy or a sign that something is seriously wrong with the company. Also, I've written about this on various blogs and I've experienced it over the years. Korea is a country that has a relatively low price to book. So to expect that price to book goes up to 2 or 3 or 4 times, not reasonable. But could it go to 1 times, 2 times, 1.5? Possible. So recently I created a short online course explaining my FVMR investing approach. Get this $97 value for free. Just go to the QR code that I have there. I'll also put it in the links below. Let's talk about forecasts. Consensus remains optimistic regarding profitability turnaround. There's 33 analysts covering the company right now, and the upside is about 38.9%. So analysts are more positive about Hyundai than the market. Market's got it at 0.8. They're optimistic that Hyundai can achieve a higher level of profitability, which would close the gap with its peers. If it can maintain a 6 to 7% EBIT margin, then this could be a catalyst for share price performance. So here we can see our expectation is EBIT margin about 6%. Now they've already done a lot of that in 2021. So really the question is, can they maintain that? So if we look at the profit and loss statement, Hyundai is likely to recognize a record profit in 2021 due to the strong car sales and increased cost cutting. As of 9 months, 2021, net profit is already standing at 4,000 or 4.2 trillion won. So they're already on their way. If achieved, it could be the starting point of turning around the profitability to industry average. So good progress so far. The balance sheet, well, the company has a solid cash position. It's got about 14% of its assets in cash, and strategic partnerships and fixed investments necessary to maintain a leading role in climate neutral car. They're doing a lot of investment there, and they do have the potential with hydrogen cars to really do something special. So now, Hyundai has moderately high leverage. I wouldn't say it's that high. Liabilities to asset ratio is about 64% in 2020, and higher jumps in retained earnings would come from increased profitability. Let's look at some ratios. Revenue is expected to rebound over the next 2 years in line with heightened global demand for sales. And so what would that mean? Let's look at that in a little bit interesting. Let's go into more detail. Shareholders should expect higher return on equity. Right now, we're forecasting about 8% return on equity. Still pretty low, because also part of the reason why Korea tends to be a low price to book value country is because it's also tends to be a relatively low ROE country. So 8% is good for Korea and 10% would be great. Now, let's also see that Hyundai has been among the least profitable car companies in the past. However, in 2021, it's proved its capability to bring profits to industry average. And this was evidenced by the gross margin, or actually, I think, the EBIT margin of 6.4 and 6.2 respectively in the quarters. I don't show the quarters here. What I show is the annual and the forecasts. Let's look at the free cash flow. Free cash flow is expected to be strong in the near future, and CapEx is likely to increase as heavy R&D investments are necessary related to hydrogen technology development of chips and batteries, but still a very positive and strong free cash flow to the firm. So let's now talk about valuation. Here you can see consensus versus my assumptions. Global car sales is likely to see some strong rebound as chip shortage eases and demand remains robust. Hyundai started to turn around the declining margin trend, which we've already seen. And the key challenge is to maintain such a margin over the long run. If we can just maintain that 6% EBIT margin, it's in a pretty good position. We think that the market has not fully acknowledged that strong efforts that got it to that 6%. They may be thinking it's going to come back down. But if we hold that 6% steady for EBIT margin, that's what we're looking at. So here we can see the free cash flow method that we're using to forecast the value of the company. The end result is a cost of equity of about 11% and a WACC of about 5% because they do have a lot of debt and the cost of debt is very, very low right now. So what do we come up for value? Our base case is 280,000 Korean won. That's an upside of 28.4. If we were to look at it more bullish, we would see about 36.7% and more bearish, about 20%. So anyway, you look at it, there's seems to be some good upside to this company. Now let's look at the world-class benchmarking scorecard. We identify a company's competitive position relative to global peers. Combined composite rank of profitability and growth, I call it profitable growth. The scale is 1, yay, that's the best, to 10, boo, that's the worst. So here we can see the company ranked against 1,040 large consumer discretionary companies. And you can see that it's not that great. 9 or 10 is terrible and 1 is great. But you can see that it is improving from 9 to 8 to 7. And what's driving that improvement? Well, profitability has a lot of room for improvement. It's 7, meaning it's below average relative to peers. It could move up. And what we can see is EPS growth is now at a 2, a very high ranking. So they are getting some good growth. So what are the risks? Well, ongoing supply chain disruptions create shortages that could lead to lower sales, failure to maintain higher level of profitability. Hydrogen strategy might not pay off, leading to wasted R&D. So let's wrap it up by looking at this company, Hyundai. And basically, the point that we want to ask is the conclusion. Parallel strategy of hydrogen and EV gives Hyundai a unique edge. Maintaining a higher margin could be sufficient for a re-rating by the market, and a low price to book multiple of 0.8 times makes it an interesting value play. So let's go back to where we started. Is this car maker's parallel strategy a potent value play? That's what I want to ask you to think about. And that is Valuation Masterclass case study of valuation of Hyundai Motor Company. If you have any questions, feel free to put them in the comments now or later, and I'll be sure to answer them. Have a great day.